Coming to you live from the CNBC-TV18 Motilal Oswal studio. Just a few minutes to go before we get the initial market pre-opening rates. So for the timing, let's get you some derivative strategies. Manoj Muralidharan, VP of Derivatives at Relicare Broking, joins us. Hi Manoj, morning. What's your sense? What do you have for us today?
Good morning, Nigel. Nigel, today specifically for the expiry, the textbook equation simply says that when you see the futures positioning in the index getting squared off, which was seen in the last trading session, it is usually a lackluster session and possibly some selling in the second half. So we believe 18,050 to 17,850, this 200 odd points is where the range might be. So better strategy here is, I guess, the SGX is positive by a good 40 to 50 points. So if we get a gap up opening closer to 18,000, 18,050 on the futures, buying a put option would be better because we're expecting the expiry might be somewhere close to a 17,920 to 950. This is the spot Nifty I'm talking about. Now, stock specific also, we believe that certain stock like Reliance becomes a good short at around 25.40 to 25.45. The stop loss should be 25.60. And we're expecting a good 40 points on the downside, somewhere close to 2500 to 2508 as a target. Now, from the IT, I guess, Infosys, though the positioning is weak, not really weak, it's low, but still we believe that there is a chance that we have always seen a good cash-based buying or delivery happening closer to 1485 level. So we believe this 1485 might be a good pivot, and there is a chance that the stock might rally all the way to 1520 to 1528. So doing a bull call spread would be a simple strategy. You can buy a 1500 call option and you sell a 1540. So this difference is hardly at 12 rupees. Keep a stop loss of 5 and you can expect a target close to 20 rupees on this strategy.
Okay, all right. Manoj, thanks very much for that. We'll come back to you for more a little later. Now, on to our momentumizers segment. And the stock we have we're talking about is CG Power. It's had 3 fantastic years, right? I mean, from the depths of sort of almost bankruptcy levels, 2020, 21, 22, and it's starting 23 on a pretty positive note. It's up 10% for the year. Sonia, tell us more.
It's a fresh record high that CG Power hit yesterday, and as you rightly pointed out, in this week alone, it's up about 11%. The volumes yesterday were up at about 50 lakh shares, which is about 36% higher than the 10-day average volume. So the buying is coming amidst large volumes. Now, CG Power, as we know, has 3 businesses: industrial, power and railways. I'm looking closely at the industrial business. It has over 35% market share there. And the big trigger for the industrial business is the plans that CG Power has in the electric mobility space. Now, they do manufacture motors, generators, alternators, etc., drives, stampings, but they're looking at EV as a big opportunity, EV motors, over the next 4 to 5 years, as per their annual report. Now, they've set up a separate EV mobility business to re-enter 3-wheelers and EV tractor motors. And as we know, this is a space where there are a lot of big investments being made from OEMs. Now, they've announced a motor segment capex at 400 crores over the next 12 to 24 months. And the breakup of this includes a 230 crore capex that they will be undertaking for a motor factory in Goa. Now, this expansion would increase their capacity of low-tension motors up to about 20 lakh units from 9 lakh units currently. So there's a big capex plan that they have. And remember, EV motors are still at a developmental stage for CG Power, but their earnings have been reflecting a very strong up move. So in H1 itself, EBITDA margins have improved about 200 basis points. And we have the Q3 earnings coming up on the 24th of Jan. And there's buying that you're seeing ahead of the numbers. In fact, I want to toss this question to Gurmeet Chadda as well. Gurmeet, I know you track this space very closely. CG Power now at 300. Is the risk reward still favorable, and how are you looking at this electric vehicle opportunity that the company is focusing on?
So Sonia, as you said, I think some of it is in the price, the way, the prices move up. And these days markets, tend to discount any positive trigger and negative trigger, the way it punishes very quickly. What we like more now at this point of time, while CG Power is startup power, it has consolidated after a good up move post-COVID. If you see, it's a more integrated business with generation, transmission, distribution. They reported a very good number. They almost did 14,000 crores of top line in Q2. The coal and Mundra business did well. They were able to recover losses in some other ones, and even the discoms did well. And they have a clear renewable goal spelled out in terms of what they want to do till 2025. expanding share in again in EV in terms of the EV charging ecosystem. They have a 40% plus market share. Solar EPC order book being very robust, almost 11% market share in solar panels as well. So that's something we like more, at this point of time, considering the valuation.
Okay.
All right.
Just want to mention that Gurmeet is talking about, Gurmeet, you were talking about Tata Power, right? Not
Yes.
CG Power.
Yes, Tata Power.
Okay, all right. Just wanted to clarify that.
A powerful bunch. But thanks very much, Gurmeet. Great to have you with us here as always, and good speaking with you. See you back soon. Well, let's talk about the pharma space now. Yesterday we saw some action. Stocks like Sun Pharma, etc. moved. Cinderella Carvalho is Vice President, Healthcare Pharma Lead at JM Financial, and she's joining us now to take some questions. Cinderella, thanks very much for your time. Great to have you with us here. Let's just start with your thoughts on Sun and what the new drug breakthrough can mean for the company.
It's a domestic launch that they are planning, and I think it's a interesting therapy in terms of the cancer treatment to bring in India. So we look forward to the Indian market, and we believe that it will add value to the India growth, where Sun continues to grow double-digit and strong in line with the market, and almost most of the months it's been ahead of the IPM also. So we see that the growth for the domestic market for Sun will remain strong, driven by new launches as well as the volume and the price growth that we expect in the IPM and that we are seeing. So we believe these launches will continue to support the growth.
So what would your top picks be in the pharma and healthcare space now, and where do you see both earnings as well as valuation upside?
So I think our topic is definitely Sun Pharma, and we like the stock, and we continue to maintain our buy rating on Sun Pharma, and we also vouch for Dr. Reddy's at this valuation, given that there is a lot of money that will come in and which we feel will be invested largely into the domestic market focus. So we like these two names strongly from the large cap pharma companies. We like IPCA from our coverage, and we also like Torrent. At this point in time, we have a hold rating, but we are on a wait and watch on Torrent. And then from a diagnostic space, we like Dr. Lal and Metropolis at this point in time. And we see that seasonally Q3 tends to be a little weaker quarter for the entire diagnostic space. However, we believe that it will be better than Q1, and Q4 could be better. The other observation is the IPM December month has come up very strong, and we are seeing a higher anti-infective growth in December month. I think this will support the weaker or seasonally weak quarter for diagnostic players as well. So that's a clue that we are driving from the IPM growth that we have just recently seen yesterday. So that's the understanding on the diagnostic space, as well as on the healthcare side. We have recently, hospital side, we have recently initiated Medanta with a buy, and we like this. We believe that hospital sector also, due to a lot of seasonality, Q3 tends to be slightly weaker quarter. There is a seasonality effect. However, Q4 tends to be normal, and the volume growth in hospital sector has been very, very strong, and we expect that we should be able to see the trend continuing with some bit of seasonality coming in this Q3.
All right. Hi, Cinderella. Good morning. Good hearing your thoughts as well. Cinderella, what about Lupin? The stock is a far cry away from the peak that we saw a few years ago, but you still have a hold rating out there. What are the key triggers on this one?
So Lupin, I think this season, I think will help them in US specifically because of certain 6-month exclusivity that Suprep launched that they have done. And with that, there is definitely the seasonality, which is flu season and Tamiflu. Lupin is one of the player in this market. So that should benefit them. However, I think all eyes on Spiriva. We expect this to come in FY24 from a full year effect. But we believe that here there is still some time away because the entire profitability is taking some time to come back to normalcy. And we believe that it might take a few more quarters for all the entire profitability to come back to normalcy once all these launches come in. So maybe 1 or 2 quarters more, and then we will relook at our hold rating.
Do you track Loris, Cinderella?
No, not officially. We do not track Loris.
All right. Okay, fair enough. Thank you very much. Good speaking with you. Loris, of course, continues to suffer big time, big selling pressure all the way from last year. Now, it's what, almost 9:10, so it's time to get our technicians back and get the 9:10 calls out of the way. Sudarshan and Mitesh are with us. Mitesh, you go first. What do you have?
I'll go with a buy on Hindustan Copper. Keep a stop at 122. Look for targets of 136 on the upside.
Okay. And Sudarshan, what about you? What's the big call at 9:10?
Buy Siemens with a stop under 28.50.
Buy Siemens, you said?
Yeah, that's right.
All right, thanks for that. That's Siemens with a stop at 28.50. Got that. Mangalam is joining in. He has Concord on his radar. Mangalam, over to you.
Well, there are two contrasting pieces of news for Container Corp this morning. The first one, of course, is that there could be acceleration in privatization of Container Corp. News reports suggest that the government is likely to invite expressions of interest this month itself, and this, Macquarie believes, is one of the triggers stock as well, which is divestment of government stake. However, on the other hand, yesterday towards dying hours of trade, we got their third quarter volume updates as well. And they weren't very good because, while year on year the volumes grew by about 5%, there was a decline quarter on quarter. And Exim, which is the mainstay of the business, their volumes grew by just 0.6%. And this is, an indication of further market share loss as indicated by or as expected by Macquarie. And importantly, this is after 6 months of the DFC coming in. So we haven't seen any significant jump from road to rail yet, and that is one thing that worries Macquarie, and as a result of which they have an underperform rating, which is the target of 620 rupees per share. So it remains to be seen which way the stock moves today. If it's on the way up, it is perhaps on expectations of faster divestment. If not, then maybe it's the volumes which is worrying the street.
Yeah, all right, Mangalam, thanks a lot for that. Well, Kotak has come out with a note on Nalco, and after a while, we are seeing a brokerage house going ahead and downgrading a stock from the metals pack. They've downgraded the rating to sell from reduce earlier, though the fair value is unchanged at around 70 rupees. They've given three big reasons, namely that the risk reward is unfavorable at these levels. Point number one, they expect earnings to be range bound for the next few years because they believe that there's limited upside for aluminium prices, and also there will be persistent cost pressure in the alumina division. Point number two, they believe there will be negative free cash flow over the next few years because of the big capex for alumina refinery, and that's return dilutive as well. And point number three, they're saying now the stock is trading at around 6.5 to around 7 times, which we know is pretty expensive. So all these 3 points, that's why Kotak is a little bit cautious on this one.
Okay, well, let's get back to tracking the markets then. We have a couple of these real estate stocks as well that could be in focus this morning. Phoenix Mills could top that list. Sonal is here to tell us why she's watching that one. Sonal, over to you.
Well, yes, the real estate space will be in focus. CLSA has written a note on some of these companies where they actually go on to say that housing growth is likely to moderate to 10% in the coming year, and office may remain flat on a YY basis. Their top picks are DLF Prestige, Embassy REIT and Phoenix Mills. So particularly about Phoenix Mills, they have upgraded it to a buy from an outperform, have also increased their target price to 1,711. They expect same-store rental growth at 12% for the mall business, and the accelerated momentum for discretionary spends, the likes of apparel, QSR, footwear, jewelry and beverages is what will aid earnings for Phoenix Malls this time around. In 2023, growth would also be aided by normalizing of trading occupancy levels as well. On the flip side, for Godrej Properties, while they have upgraded the stock to an outperform from underperform, they've cut the target price to 1417 from 1523, and this is because they think the profitability outlook for Godrej Properties is weaker. Additionally, they have also cut target price for Suntec from 590 to 502 due to delay in the new launches that the company has been talking about.
Okay, thanks a lot for that. I just want to mention that a couple of these stocks, Phoenix Mills actually is having a good run this morning. It's up in the green. A lot of the other names, some of these names in the broader markets, transformers and rectifiers, one of them has been hitting fresh 52-week highs. So keep an eye out on that. That's up another 1.5%. Something like an NMDC is holding up in the green. Zomato is coming back as well. Mitesh, just some quick thoughts before the market opens on these real estate stocks. Godrej Properties, Phoenix Mills, anything that you like from a technical standpoint?
In fact, Godrej Properties is something which is on my radar. It's made multiple lows around this 1160, 1170 zone, starting from sometime in October. I think we've seen this level hold out many times. And now I think once you get a reversal about 1245, 1250, then I think the stock should get into an uptrend with a target of 1320 on the upside, which is closer to the 200 average.
Okay, we just have about 30 seconds left for the markets to open. Looks like it's going to be a quiet opening. I think that's something that the street could take with both hands. We have lots of big cues lined up later in the day, so the market could be in wait and watch mode. One of the big movers this week has been Tata Motors. It's up 10% for the week, and in all likelihood, it could see an up move today as well. So just keep an eye out on that. And metals in general have been moving up. So Hindalco, Tata, JSW Steel are all trending on the green line. Well, here's the first tick that's coming up for you in just seconds from now. Very quiet with a bit of a positive bias. The Nifty holding above the 17,900 mark, which means it's now back above the 100-day moving average. The mid-cap index is having a better showing this morning, up almost 100-odd points. The Bank Nifty is sulking a bit, led lower by Axis Bank, HDFC Bank, ICICI and Kotak Mahindra Bank. So there's a bit of an underperformance that you're seeing on the Bank Nifty. But what's leading the market higher is HCL Tech ahead of its numbers. So that's interesting, up about 1%. Both HCL Tech and Infy actually ahead of their earnings are in the green. Coal India is up about 1%. Power Grid, HDFC Life, Titan are holding up on the green line as well. And something like an ONGC, Infosys, Wipro are other stocks in the green. A lot of auto stocks are catching up. M&M, Maruti Suzuki are in the green. And L&T is something that's also moving with some amount of vigor. In fact, this week, apart from Tata Motors, you have TCS, Hindalco that have been other big gainers this week, and TCS continues to trudge along on the upside, now up almost about 0.5%. Very, very quiet opening for the market. It's actually a good showing in the broader markets because the advance decline ratio is now well in favor of advances and almost 4:1 in favor of advances. So that's 1,500 stocks there. What are you looking at in the broader market?
Well, quite a few stocks, Sonia, that are moving around in today's trading session. First thing on the index itself, the Nifty, the call earlier today was don't chase the opening. That seems to have played out because as we speak, the Nifty is almost in the red. So just keep that in mind. The other few stocks that are doing pretty well in today's trading session include RailTel. Remember, they won an order, 170 crore order in Puducherry and 123 crore from NMDC. So that stock is higher in trade. It's up close to 2.5%. ONGC and Oil India, I think we saw some green out there because crude oil prices had spiked up overnight. IIFL Wealth, they'll be considering a stock split or a bonus in the January 19th board meet. So that's up, I think, close to around 4.5% odds. Keep an eye out on that one. You have PB Fintech. They've got the in-principle nod from the RBI to set up an account aggregator business. Shiva Cement, nod from the Odisha Pollution Board to operate their clinker unit. So that's doing pretty well. And DB Realty, well, in pre-open itself, the stock was up close to 5%. I think in trade, they'll be paying close to around 186 crores as a final settlement to the lender, Reliance Commercial Finance. So that one, in fact, doing pretty well. So a few stocks doing pretty well on the list out there. What else, Prashant?
I mean, it's flat, right, Nigel? So just 7 points now on the Nifty. So 17,900. It's, I guess, gone into a bit of a holding pattern kind of range. So we'll see. Just a few other names. Nalco, we just highlighted the Kotak downgrade. The stock starts 3% lower, and it's on the back of volume. So it's a large cut coming through right out of the gates. Tata Steel is down about 0.7%. So 118. Hindalco, we mentioned 0.75% lower. So metals broadly are a little lower, starting a little lower, led by, of course, what's happening on Nalco. Asian Paints is another one, which we should put out. 1.33% lower on Asian Paints. That's a large Nifty name, and it's coming up on decent-sized volumes for this point in the day. And then there is ICICI Bank, which is also starting in the red, but it's got volumes, and that's why I'm mentioning it at this stage. Let's just look at the advances and where we have volume-led gains. HCL Tech is added on. It started higher. It's up 1.5%. It's, of course, the cheapest large-cap IT name, so that helps. There is IIFL Wealth, which is coming up on my screen, 3.5% higher, second largest volume traded name, so it's got volume push. PTC is up about 1.5%. Naukri saw a bit of movement yesterday. There is follow-up, 1.75% higher on, that is Policy Bazaar, beg your pardon. Policy Bazaar, 476 on Policy Bazaar. Markson's Pharma has been all over the place. That's, again, coming up with large volumes. Naveen Fluorine starts 2% higher. So that is at about 39.75 or so. So these are initial tentative rates which are coming through. Then there is RailTel, Route Mobile. Route Mobile has got a 4% pop. and so on and so forth. I mean, down the list, volumes start to thin out quite significantly. But for now, it's a 30-odd point decent start, 25 points higher kind of market. So off the highs, off the opening gap, but 17,922 is where we're at. Later in the day, of course, we get that big inflation number out of the US, and that's important. I mean, that is the one number, actually more than the labor market data, which has swung things around, quite violently sometimes. So let's just hope, as I said, fingers crossed, it kind of shows that, the big macro problem for the world, which has been inflation, at least in the US, is starting to come under control. Venugopal Gare is Managing Director at Bernstein. He's joining us this morning. He's a market master of the day. Venu, great to have you with us here. Thank you very much for your time. I mean, let's just begin there, right? What is your kind of top-down view for markets this year? Generally, most are saying that the view is that we'll get a slowdown, global growth slowdown. Valuations are a bit rich. So be more disciplined this year in terms of exposure to equities. Go on.
Thanks, Prashant. So this is, the broader interesting view for us is that while things have changed quite a bit as we sort of set into this year versus, previous year, beginning of previous year, especially in the macro setting, I guess things have changed from a domestic viewpoint of view. I mean, in a very simplistic way, heading into this year, macro is expected to slow down as compared to a very different view last year where macro was actually strengthening, given the base effect advantage we had last year. So there is, to an extent, a lack of macro buffers in our view, which is a big challenge. We could digest high valuations last year because of that, but I guess now valuations are a problem. More importantly, China reopening does lead to some positivity and momentum, relative momentum for China versus India. While at the same time, I guess on the global side of things, to me, things don't appear that bad. Now, the reality is that we're not building at this juncture a case for a deep recession. Most of my model works on a base case of a marginal recession than anything else. If it was a deep recession, then I would have been more positive on India rather. So, so from that point of view, peaking of inflation and interest rates is actually not a bad, sort of situation, given the impact of that in earnings, positive impact on earnings as well. So if you want to look at it from a perspective, there are both positives and negatives. But then I guess things are a bit more tilted towards negatives and risks for India at this juncture. So to a large extent, we hence ended up taking a view that if you take a point-to-point view, which is beginning of this year to the end of the year, we might end up at a similar overall index level. So that is that initial thinking, but the first half of the year, we are looking for a moderation of the index and then a bottoming by the middle of the year, post which we expect positive returns. So that is a broad setup that I see for now.
Okay, that's fair. So you're looking at a mild recession perhaps in the US. Venugopal, good morning and thanks a lot for joining in. I wanted your thoughts on how one should approach the IT sector now. Almost everyone has these top IT companies in their portfolios. Do you think the worst of the bad news is in the price already? Or do you see this mild recession that you're talking about hit client spends further and maybe further downgrades through the course of the next few quarters?
Yeah, so no, sir, that's right. See, a contrarian view would be to be positive on exporters, right? So IT is one of them, healthcare is another one such entity. Now, the reality is, if you look at IT, growth slowdown is inevitable. Of course, a part of that is also a moderation post-COVID, because COVID led to a fairly intense strength in growth as well. But I guess the debate was about the intensity of growth slowdown, which is where I guess a lot of cues are being sort of taken from what companies are reporting. But the reality is that the way we look at it is the milder recession scenario. We don't really bake in a situation where there's going to be hard landing for IT. So what it means primarily is while growth will slow down, it will not be that bad or in a very different way. Probably it's already priced in, especially given, as I have always mentioned from the middle of last year, that the margin levers are coming back, especially given the fact that, wage costs are a pretty large proportion of costs for this sector. So on a top-down, we would probably say that given where I see the world for this year, I guess to a large extent the risks are priced in, is the way I would look at it. It doesn't mean that we're going to make massive absolute returns in IT, but that holds good for the market as well. So we're anyways looking for outperformance.
Okay, hi Venu, good morning. As we speak, we have a large trade that's taking place on Nykaa, 1.5 crore shares changing hands out there. That's close to around 0.5% odd. Well, from the new age themes, they are totally shunned, and it's a minority camp that's actually was looking at it. Suddenly, in the last month, last 45 days or so, there is parts of the market that are getting a little bit positive. Now, Zomato, I think, was one stock that you're fairly okay on. Are you all looking at the other new age themes? Do some of them provide some kind of opportunity?
Yeah, so Nigel, I guess to a large extent you're right. Digital new age new ecosystems, they call it as, are pretty unloved even at this stage. Now, the truth is that this is not an India-specific feature. Emerging market stocks, including China and of course now the last wave where US stocks are also seeing a hit, in terms of how people are looking at tech, especially around growth and profitability. Now, the reality is that for us, the way we look at it, even though we were very, very optimistic on digital ecosystem during the COVID time, last year from a strategy portfolio point of view, we had turned cautious beginning of last year in outlook report, but we have turned positive now. Now, the reality is that we still want to be very specific on business models at this juncture. So what it means is that we are not going to be an all-out, all ecosystems positive, and especially because if you look at India, any of the stocks you mentioned, all of them are still significantly costlier in the EM basket. So they're not cheap relative to EM basket. So the reality is we need to look at business models. In this, our broader thinking primarily is a combination of, the market structure, which is very important for us. So for example, one of the stocks you mentioned, especially Zomato, our broader thinking is, market structure in food delivery is pretty good. And the second aspect per se is more about the path to profitability, which is another aspect which is very important for us when we pick stocks. So the summary is we would still want to be very stock specific at this juncture and be very conscious of valuations. And remember that there is a cap because a lot of these new economy companies still would have outflows, especially from the original investors. So you can't, again be in a situation where they double and not expect the outflows to commence. So that's the only cap that you should probably observe this year.
Which are the other sectors, Venugopal, that you like, perhaps where there is both valuation and growth upside in 2023?
Okay, so the reality is valuation upside is very, very theoretical because I think everything is costly. Everything is costly. So to put that into picture, I guess the largest sector, financials, is the one which is a consensus overweight. So we decided to hug with a consensus overweight there, and we have actually increased weights of financials. Now, that was not a valuation call. That was a call that we still expect credit growth to be healthy this year, and we know that it's early cycles, so NPA creation, provisioning will be lower. And I guess the challenges will start 3-4 years later, but that's something to worry about later. The financials is a key other overweight. Consumer durables is another overweight for us, which we just moved to an overweight, despite being overall cautious in consumption in general. So this is primarily to play a slightly more nuanced view around rural recovery, which is broad-based economy recovery and valuations as well, which is the factor. We also have a overweight in healthcare, which is a overweight which is continuing from last year. So last year it didn't do well for us. But then we think it's again a situation where things are bottoming out. So these are the sectors. It's a very narrow focus because we moved quite a few other sectors to an underweight or neutral, through the year.
It's you're grudgingly bullish on these sectors, right? Am I wrong in putting it like that? Yeah. Or there's no kind of table thumping view, right? Well, this looks good, or there is kind of it's not there. I mean, so that's the way you see it. Am I wrong in paraphrasing? Yeah, go on.
Given a choice, I would not put money in equities right now. But unfortunately, I don't have the choice because most of my work and investors I speak to must invest in equities, right? So they need to take a relative call. If at all, if I were to just push myself, I still think financial sector is somewhere where I would look for absolute return opportunities. So that's the only place where I'll probably be more confident about.
Well, in financials, banks, PSU Banks, they were the darlings last year. Some part of that re-rating seems to have played out. Do you believe they're still good for more, or would you stick to that largest name in there?
Yeah, so we are sticking to the largest name in there. So remember that there's a reason why, of course, they rallied. Growth came back, and concerns on probably provisionings as well came down. But the reality is, you'll probably also see fundraisings commence in the sector. I would probably hence still stick to the larger top tier names where I guess they won't, there'll be limited risk of fundraising as well coming through. So most of them are pretty well stacked up, the top 3 or 4 players, which includes the private sector banks, the 3 of them, right? So in our portfolio, which is India portfolio, we have SBI, HDFC Bank, as well as Axis now. So SBI and Axis are new introductions as we pave the way out for ICICI after it having done really well for us. So that's where we are right now. I would also want to broad base my view on financials. Given a chance, I would want to move down the tiering as well, even though it's not articulated in terms of any stock calls right now. But that's another thing I would want to do.
All right, Venu, final question before we let you go. I think you're fairly positive even on real estate cycle. That's been gone through a torrid patch, actually. Maybe the last 10, 12 years, in select parts, it's been quite bad. But now we're seeing a revival out there. You like that theme? And also, how do you play it? Via the housing finance companies, the building products themes, or cement?
Yeah, so my broader thinking is, yes, you're right. So real estate is early cycle. We've got a good couple of years to go before we think about peaking of the cycle. And in my view, it's also not that interest rate sensitive. Early cycle end markets are not very interest rate sensitive. So even when rates are rising, we're not too worried about the impact on real estate. So the question is, how do you play it? One of the ways to play is to the financial sector, but it's not too narrow, not a great way for to look at direct exposure. The other way to approach is primarily through durables, which is also not a bad way to play it. So durable overweight probably reflects that. And pure play real estate companies are all mid caps, which we are pretty open to. But just to put in context, we can never take a blanket view on real estate companies because some of these larger real estate companies, essentially are exposed to individual projects. So we're generally positive on some of these good quality private, sort of real estate names. And lastly, cement. I forgot to mention that's another area where we are positive on this year, despite us not expecting any price hikes. But that's also very significantly real estate linked. There's a broad-based real estate play.
Venu, sitting in Singapore, mortgage rates with what they are, 1-2%, right? Or have they risen? I don't know.
They have risen, yeah.
I mean, it's a world of difference, right? India, and world of difference in terms of... But I'm just making that point about rates going up and not really having a significant impact on home ownership or the pace of home buying.
Prashant, where India's mortgage rates are, it is pretty acceptable. Look at where US fixed rate mortgages right now, right? So US is almost, just marginally lower than India, if at all. So actually, India looks attractive from that perspective. And look at affordability. Like 7 years, no price increase. We've all lost money in real estate. That's the reality. So, right.
I think what stayed with me, Venugopal, is you saying that if I had a choice, I wouldn't invest in equities this year, right? That says it all. You don't have a choice, but we do. So I guess investors who are watching you right now, they don't need to invest in equities this year, considering that it's going to be a tricky year. But thank you so much for joining us and taking us through what your expectation is for 2023. But let's take that discussion forward. Goldman Sachs has written a note where they suggest that India's growth is most likely to be moderate in the first half of FY23 with a fading reopening boost. Corporate profits are predicted to grow 15% in 2023 and 2024. To discuss what to expect from the markets, we're joined by Sunil Kaul, the Asia-Pacific equity strategist at Goldman Sachs. Sunil, good morning and Happy New Year to you and your entire team at Goldman Sachs. I just wanted your thoughts, on what the earlier guest was telling us, that if he had a choice, he wouldn't invest in equities this year, and perhaps there are better asset classes out there. Would you concur with that view? And what's the most prudent investment strategy for 2023?
Look, I think in terms of equity markets, we actually remain fairly bullish on the longer-term prospects for Indian equity markets. But we actually started with the more market weight allocations because of high valuations and the fact that we expect within Asia rotation happening from India and ASEAN, which have been leaders, to North Asia, China, and the North Asian markets of Korea and Taiwan specifically. I think with regards to your question, Sonia, about asset classes, we do concur somewhat with the notion that the fact that fixed rates are rising, there could be some re-asset allocation within households from equity markets to fixed income alternatives. And so if you look at equities versus bonds, the yield gap between equities and bonds are actually at multi-year lows. And so relatively speaking, equities are less attractive compared to bonds, compared to the history. But if you look at the longer term trajectory, as I said, India still looks at an attractive market from a secular growth perspective.
All right. Hi, Sunil. Good morning. Sunil, do you think this could be a year where if the globe doesn't perform, then India will outperform? We'll fall less. But if the global markets perform after having an off year in 2022, India could underperform. Do you think that's a possibility?
Look, I mean, we are fairly optimistic on the Asian markets overall. So we're sort of looking at mid-teen returns for the region overall. But as I said, look, India has been a strong outperformer for 2 years in a row. If you look at the last 30 years of India's history, there's only once in the last 30 years India has actually outperformed thrice in a row. And that was during 05 to 07 cycle when the global growth was also very strong, which is not the case this time around, right? So I think our base cases look, the region does fairly well. The first half will be led by China and North Asian markets, notably Korea. The second half, once the China rally becomes more mature, you can see India coming back and focus and take the leadership. And we have a Nifty year-end target of 20,500, which is a sort of a low-teen returns, but that will be kind of more back-end loaded towards the second half of the year.
Sunil, good morning, Prashant here. You cover a certain number of stocks here in India. Do you, and I'm assuming those are the well-traded, large liquid names, right? I mean, of course, you've got coverage in lots of mid-caps, etc. as well. Do you feel compelled to kind of expand that coverage universe to find newer ideas? Because, the ones where there is a lot of institutional coverage, it's, the large ones, valuations are, according to some, like, for example, the previous guest, perhaps full, not too much margin of safety, etc. Just wanted to understand how you think about that.
Yeah, I think, Prashant, you're right. I mean, in terms of valuations, look, I mean, India is the most expensive market in the region, right? It's still trading at 22 times forward earnings, which is higher than the rest of the markets in Asia. But the one comforting thing is that with the rally in the rest of the markets, notably the strong recovery we have seen in China, the valuation gap between India and the rest of the markets is also shrinking. And so if you looked at the peak at the end of October, India was trading at almost twice the valuations for the overall Asian region at almost 22 times. The region was at 11 times. So we had a premium of about 100%. That has come down to around 65%. The long-term average is around 30. So there is still some room for further contraction. But the fact that other markets are catching up, India's relative premium is at least come down. I think with respect to your question in terms of whether you need to look at sort of more stocks within mid or small caps, I would say, I mean, India is a fairly large and liquid market overall. I mean, you got sort of more than 2,000 odd stocks in the index, and there is enough alpha to be generated within the market. I would say even beyond the top stocks, we do like the broader theme of, for example, Make in India. And as you know, a lot of those names are in the sort of mid-cap range. And we actually recently published a series of reports together with our economists and sector analysts covering that theme, which we're sort of very bullish on. So I think there are enough alpha opportunities within different thematic buckets which we can play, even beyond the large cap names.
Can you, just elaborate on this Make in India theme a little more? Which are the pockets that you like? Because it's a fairly large umbrella, and within that, there's so many pockets, right? I mean, there's defense, which has done really well over the last 1 year. But specifically, what are you looking at under this Make in India umbrella?
Yeah, so we did a deep dive on all the sort of 14 sectors that have been covered by the PLI schemes. So we have sort of broadly bucketed them into 3 different categories. The major ones being the import substitution, which will include your electronics manufacturing, autos, and the likes of those. And then the other broader bucket is the energy transition bucket, which is your EVs, solar, batteries, sectors like those. And then there is some more sort of other sectors which are sort of more export oriented, like as you said, and sort of more strategic sectors like defense and textiles. So in terms of the broader bucket, I think it's fairly reasonable to say that India has done a decent job when it comes to electronic manufacturing, and I think mobile manufacturing is a good example. So I think that sector, including sort of autos, ancillaries, those sectors are the ones where we think that India is ready. You don't need, you have a large domestic market. You already have some economies of scale, so you don't need a lot of know-how or technology transfer from global companies, and also these are not very capex intensive sectors, so you're more likely to see profitability coming through into these sectors, as opposed to sort of energy transition bucket, wherein you are talking about solar, EV. I think that's where you need a little bit of more energy transfer. You need some more capex intensive, and the gestation period for those sectors tends to be longer. So we think that sort of materializes more into sort of beyond the 5-year bucket, whereas the other sectors probably start to show up in the numbers in the 3 to 5 year range.
Well, Sunil, we have outperformed in the recent past, and that's predominantly because earnings growth as well is going to be the best in India. And that target of 20,500, it's premised that we get that mid-teens earnings growth. What's the downside risk out there? Because there are some pockets of weakness that may result in us not getting those mid-teens growth, and then in turn, it will reflect on the Nifty target as well.
No, Nigel, I think you're absolutely right. I think the 15% profit growth we are expecting, as I said, is actually higher than what we are expecting for the region. On a 2-year basis, we are expecting 9% earnings growth for the region. So India, we do expect stronger profitability, which is partly driven by the fact that the domestic economy is very strong. But obviously, I think there, as you said, there are downside risks to those. I mean, in terms of our numbers, we're actually fairly in line with consensus. But if you look at the sectoral mix, we are a little bit more optimistic on financials, where actually the balance sheets are really are strong, and that seems to be the consensus overweight sector at the point. We are also, as I said, more optimistic on the manufacturing sector, that the sectors where, and energy included, driven by the large cap index heavyweight there, but the sectors where we are actually below consensus are more in the externally linked sectors, including infotech as an example, as well as the consumer sensitive sectors, because we are seeing some slowdown in the mid to high end consumption. But I would say I think the downside risks probably lie if you start to see slowdown in consumption, which hits some of the consumer sensitive sectors. But in terms of our estimates, we're already sort of baked a moderation in top lines. The reason we are a little bit more optimistic on the overall profitability is because we think margins have likely sort of bottomed out in terms of input costs, and so you could see actually in the next couple of quarters some margin expansion, which is why we think that mid-teen earnings growth is pretty achievable.
All right, Sunil, we'll leave it there. Thank you very much for your time. Good speaking with you, and thanks indeed for making the time here on CNBC TV18. The market's still there, 30 points, not very much. 17,927 on the Nifty. Advanced decline is positive, and just a few names. Naveen Fluorine, I mentioned earlier at open. That's the top volume-led gainer now, 5% on Naveen Fluorine. RVNL was not there in the mix earlier. It's up 4% at about 75. Hikal is another new one, which is now up 4% on decent-sized volumes. Care Ratings is up 6%, so that's a big one, 671 and 672 actually on Care Ratings. And I mentioned RVNL, but look at Railtel. So maybe it's a sectoral thing, but keep an eye. Mirza International is another one, the shoemaker, the leather company, 9% higher, 238, 239 on Mirza. So that's a big mover. Viatech, Wabag, Ircon. So yeah, I mean, rail infrastructure perhaps is one theme which is starting to come back, and there is action which is visible in more than a few companies there. We'll take a break here. We'll have the management of Greaves Cotton join us next to talk about the company's launch of a range of new electric vehicles at the Auto Expo. And of course, a bit about the company's outlook going forward as well. Stay tuned. Later, we analyze expectations from the banking sector in the third quarter and a special quarter segment. We'll have Santanu Chakrabarti of BNP Paribas with us post that. Stay with us.